Hey, ever feel like your money is just sitting there, maybe growing a little, maybe not enough to really get you excited about your financial future? Or on the flip side, do you ever lie awake at night wondering if you're taking on too much risk in the pursuit of bigger returns? If either of those scenarios sounds familiar, you're in the right place. Today, we're diving deep into the world of Acorns and tackling a crucial question for any investor, especially those just starting out: conservative versus aggressive portfolios, which one reigns supreme? Now, Acorns has become a super popular platform, and for good reason. It makes investing accessible, almost effortless, by rounding up your everyday purchases and investing the spare change. It's like magic for your money. But once you sign up, you're faced with a choice: which portfolio strategy aligns best with your goals and, perhaps more importantly, your comfort level. Before we pit these two investment philosophies against each other in the Acorns arena, let's take a step back and understand what each of them truly means. Think of your investment portfolio as a carefully constructed team of players, each with a specific role to play in achieving your financial goals. A conservative portfolio is like having a team built on solid defense and reliable, consistent players. The primary goal here isn't necessarily to hit home runs, but rather to protect your principal, the initial amount of money you invest, and achieve steady, albeit potentially slower, growth over time. This type of portfolio typically leans heavily towards lower-risk investments like bonds. Bonds are essentially loans you make to governments or corporations, and they generally offer a fixed rate of return. They tend to be less volatile than stocks, meaning their prices don't fluctuate as wildly. A conservative portfolio might also include a smaller allocation to stocks, often focusing on well-established, large companies that are considered relatively stable. The overall aim is stability, preservation of capital, and gradual growth, making it a popular choice for those nearing retirement, individuals with a shorter investment time horizon, or those who simply prefer a less bumpy ride. On the other side of the spectrum, we have the aggressive portfolio. This is your high-octane, growth-seeking team. The strategy here is to maximize potential returns, even if it means taking on more risk. An aggressive portfolio is heavily weighted towards stocks. Stocks represent ownership in a company, and their prices can fluctuate significantly based on the company's performance, market conditions, and a whole host of other factors. While this volatility can be nerve-wracking at times, it also presents the opportunity for substantial growth over the long term. Within the stock portion of an aggressive portfolio, you might find a focus on smaller companies, which have higher growth potential but also higher risk of failure, emerging markets, or specific sectors believed to have strong future prospects. The underlying philosophy is that over a longer investment horizon, the potential for higher returns outweighs the increased risk of short-term losses. This approach is often favored by younger investors with a longer time horizon to recover from any market downturns. Now that we have a clearer picture of what each strategy entails, let's bring it back to Acorns. Acorns offers several pre-built portfolios that range from conservative to aggressive, making it easy for users to choose one that aligns with their risk tolerance and investment goals. These portfolios are typically constructed using low-cost exchange-traded funds, ETFs, which are baskets of stocks or bonds that track a specific index, like the S&P 500. So, when you choose a conservative portfolio in Acorns, you'll likely see a higher allocation to bond ETFs and a lower allocation to stock ETFs. Conversely, an aggressive portfolio will have a much larger percentage of your money invested in stock ETFs. This brings us back to our central question: which one is best in Acorns? And the truth is, there's no single best option. The ideal portfolio for you depends entirely on your individual circumstances, specifically your time horizon, your risk tolerance, and your financial goals. Let's break these down. Time horizon: this refers to how long you plan to keep your money invested. If you have a long time horizon, say 20, 30, or even 40 years until retirement, you generally have more time to ride out the ups and downs of the market. This longer time frame often makes an aggressive portfolio a more suitable choice. Why? Because historically, stocks have outperformed bonds over the long run. While there will be periods of volatility and even market crashes, the potential for higher average returns over several decades can significantly boost your overall investment growth. Think of it like planting a seed. The longer you let it grow, the bigger the tree can become. On the other hand, if you have a shorter time horizon, perhaps you're saving for a down payment on a house in the next 5 to 7 years, or you're approaching retirement within the next decade, a conservative portfolio might be more appropriate. The priority here is capital preservation. You don't have as much time to recover from potential market downturns, so minimizing risk becomes paramount. While the growth potential might be lower, the stability offered by bonds can help protect your principal and provide more predictable returns over a shorter period. Risk tolerance. This is your personal comfort level with the possibility of losing money. Investing in the stock market inherently involves risk. The value of your investments can go down as well as up. If the thought of seeing your portfolio value decline significantly makes you anxious and prone to making impulsive decisions, like selling low, then a conservative portfolio is likely a better fit, regardless of your time horizon. It offers a smoother ride with less volatility, which can help you stay the course and avoid emotional investing mistakes. However, if you have a stomach for market fluctuations and understand that temporary dips are a normal part of the investment journey, an aggressive portfolio might be suitable. You're willing to accept the higher potential for short-term losses in exchange for the possibility of greater long-term gains. It's about understanding that with higher potential rewards often comes higher potential risks. Financial goals. What are you ultimately saving and investing for? Your goals can also influence your portfolio choice. If your primary goal is long-term wealth accumulation for retirement, and you have a long time horizon, an aggressive approach can help you reach that goal faster, thanks to the power of compounding. Compounding is essentially earning returns on your initial investment and on the accumulated interest or earnings. Over long periods, this can lead to significant growth. If your goals are more short-term, like saving for a specific purchase or having a more stable nest egg in the near future, a conservative portfolio might be more aligned with those objectives. It prioritizes stability and capital preservation, ensuring that your funds are less susceptible to market swings in the short run. With that said, thanks for watching and until next time.